Most retail traders look at a chart and see random red and green bars, completely blind to the fact that the biggest institutions in the world are leaving a massive footprint right in front of them. When two specific candlesticks combine in a precise sequence, they stop being simple price data and turn into an institutional cheat code that signals an immediate reversal of millions of dollars. If you are still trading single candles or chasing lagging indicators, you are essentially gambling against algorithmic systems designed to take your money. Over the next few minutes, we are breaking down the exact double candlestick patterns used by Wall Street insiders to predict massive market flips before they even hit the news. This is not textbook theory. This is the raw mechanical blueprint of market psychology that will completely shift how you look at a chart forever. 90% of retail traders lose their entire account because they try to predict a market reversal by catching a falling knife. But smart money waits for a structural failure in price action, and that failure leaves a perfect footprint known as the tweezers. This pattern is the ultimate visual trap where retail traders get liquidated while institutions quietly heavy load their positions in the opposite direction. If you do not know how to spot the exact line where bears completely run out of breath or where bulls hit an invisible brick wall, you are walking blindly into a slaughterhouse. Look at the left side of your screen at the tweezer bottom, which is a powerful bullish reversal pattern. Notice how price is aggressively crashing down in a steep downtrend with consecutive red candles. Then, something critical happens. A solid red candle drops down, but the very next candle is a green bullish candle that opens and completely rejects further downside at the exact same price level. This creates a structural phenomenon called equal bottoms. The psychology here is simple but lethal. The sellers tried with all their capital to push the market lower, but a massive block order from major institutions completely absorbed the selling pressure. At that exact bottom line, the moment you see these twin candles matching lows perfectly after a downtrend, it means the bears are officially trapped, and a massive upward explosive rally is about to begin. Now, look at the right side of your screen at the tweezer top, which is the exact opposite and acts as a bearish reversal pattern. Price is climbing beautifully in a clear uptrend, making retail traders experience massive FOMO and buy right at the peak. A strong green candle pushes up, but the very next candle instantly reverses into a sharp red candle, failing to break even a single fraction above the previous high. This forms a perfect resistance line known as equal tops. What is happening behind the scenes is that smart money has just placed massive sell orders, locking the price down and creating an artificial ceiling. Retail buyers keep hammering the buy button, completely unaware that institutional algorithms have already slammed the door shut. When these equal tops form at the peak of a rally, the buying momentum is completely dead, and the market is primed for a violent, crushing drop now. Let us move to our next set of institutional footprints, which trap retail traders by using unexpected price gaps. Look at the left side of your screen at the piercing line pattern, a highly reliable bullish reversal indicator. The market is in a clear, aggressive downtrend, driven by strong selling momentum. Suddenly, a large red candle closes near the bottom. The next candle opens with a sudden gap down, completely fooling retail traders into thinking that the crash will continue. Amateurs immediately jump into heavy short positions right at the open. But look closer at what happens next. The buyers step in with massive volume, pushing the price violently upward until the green candle closes well above the 50% midpoint of the previous red candle. This is pure institutional manipulation. The smart money deliberately created a gap down to trap the last remaining sellers and accumulate cheap shares before triggering a powerful upward bull move. When you spot a green candle piercing deep into the upper half of a dominant red candle, the downtrend is dead, and the buyers have taken absolute control. Switching over to the right side of your screen, we see the exact opposite behavior with the dark cloud cover, which is a textbook bearish reversal pattern. Here, the market is riding a strong, profitable uptrend, making retail buyers ecstatic. A solid green candle extends the rally, and the next candle gaps up even higher, triggering intense fear of missing out among retail traders who start buying aggressively at the absolute peak. However, instead of continuing upward, massive institutional sell orders hit the order book. The price turns around instantly, crashing down heavily to close deep inside the lower half of that previous green candle, penetrating way past its 50% midpoint. This forms a dark cloud over the bulls. The smart money trapped all the late buyers at the absolute high to secure maximum liquidity for their own short positions. The moment this candle closes deep within the previous bullish body, it signals a massive institutional distribution phase, and a crushing, long-term bear move is officially underway. Next, let us break down one of the most psychologically intense patterns on a price chart, which signals a complete exhaustion of market momentum. Look at the left side of your screen at the bullish Harami pattern, a classic indicator of a trend reversal. The market is sliding down in a heavy, aggressive downtrend, printing large red candles. Amateurs look at the massive red candle at the bottom and panic, thinking the crash will never stop. But look at the very next candlestick. It is a small green candle that opens and closes completely inside the body of the previous giant red candle. This is the institutional footprint of absorption. The sellers tried to push lower, but huge institutional buy orders completely consumed the selling pressure, trapping the price tightly inside the previous range. The massive red momentum is officially dead, and the small green candle proves that buyers have silently stepped in to accumulate positions. Once this inside bar forms at the bottom of a crash, the market breaks into a powerful upward bullish move now. Shift your eyes to the right side of your screen to analyze the exact opposite scenario, known as the bearish Harami pattern. Here, the market has been climbing beautifully in a strong uptrend, making retail traders experience massive fear of missing out as they buy at higher prices. A huge green candle spikes up, making everything look incredibly bullish. However, the very next candle opens with a sudden gap down and closes as a small red candle, completely swallowed inside the massive green candle's body. What is happening behind the scenes is a major block order distribution by smart money. The institutional algorithms have stopped supporting the higher prices and are quietly absorbing all the retail buy orders to build their short positions. The explosive buying momentum has hit an absolute brick wall. The moment you see this small red candle resting inside the massive green body at the peak of a rally, the uptrend is structurally broken, and the market is primed for a heavy, devastating bearish drop. Now, let us examine the most aggressive and explosive double candlestick pattern on a chart, which represents an absolute shock to market sentiment. Look at the left side of your screen at the bullish kicker pattern. The market is sliding down in a steady, controlled downtrend with sellers completely in charge. Then, after a solid red candle closes at the bottom, something unbelievable happens. Instead of opening at or near the previous close, the very next candle opens with a massive, violent gap up, completely bypassing the previous candle's opening price. Amateurs who were heavily shorting the market are instantly trapped in massive losses, forced to panic buy and cover their positions. This huge gap up is a direct result of institutional algorithms slamming the market with overwhelming buy orders, leaving zero time for retail traders to react. The momentum shifts instantly, from heavily bearish to intensely bullish, without any warning, sparking a powerful, unstoppable upward bull move. When you spot a kicker pattern, do not argue with the chart. The smart money has completely flipped the switching over to the right side of your screen. We see the exact same psychological shockwave in reverse, known as the bearish kicker pattern. Here, the market is climbing smoothly in a strong, confident uptrend, filling retail buyers with intense fear of missing out. A green candle closes near the peak, making everything look completely safe. But right at the next open, the market experiences a devastating, sudden gap down, opening entirely below the opening price of that previous green candle. All the late buyers who entered at the top are instantly trapped underwater with no escape. This is a massive institutional rug pull, where major banks and hedge funds dump millions of shares onto the market. simultaneously forcing an overnight trend reversal. The buying power is instantly obliterated, and the market plummets into a heavy, crushing bear move. A bearish kicker is the ultimate warning sign that the party is officially over, and a severe market crash has begun. Finally, let us look at the absolute king of double candlestick patterns, which represents a complete takeover of market sentiment. Look at the left side of your screen at the bullish engulfing pattern. The market is sliding down in a continuous, bleeding down trend with consecutive red candles. Near the bottom, a small red candle forms, showing that the selling pressure is slowing down. But look at what happens next. A massive green candle explodes off the open, completely swallowing or engulfing the entire body of the previous red candle. This is the ultimate institutional trap. The smart money entered the market with overwhelming buy orders, completely wiping out all the sellers in a single move. This absolute dominance by the buyers signals that the downtrend is completely finished, and an aggressive, powerful upward rally is officially underway now. Switch over to the right side of your screen to analyze the exact opposite force, known as the bearish engulfing pattern. Here, the market is climbing beautifully in a clear, highly profitable uptrend. At the very peak of the rally, a small green candle prints, giving retail buyers false confidence. Suddenly, a massive, dominant red candle opens and crashes down heavily, completely engulfing the entire body of that green candle. What is happening behind the scenes is that major financial institutions have slammed the market with huge sell orders, completely overpowering every single buyer at the top. The moment this giant red candle closes and swallows the previous green body, it proves that the buying momentum is dead, and the market is about to experience a crushing, long-term bear move mastering. These 5 double candlestick blueprints is the exact boundary line that separates a struggling retail gambler from a consistently profitable trader. Understanding how smart money manipulates price action between these candles is the only way to protect your capital and grow an account in any financial market. If you found high value in this breakdown and want to stop losing money to institutional algorithms, make sure to smash that like button right now and subscribe to the channel. We drop institutional grade price action blueprints and trading strategies for beginners every single week, designed to turn you into a sharp, independent trader. Drop a comment below telling me which of these 5 patterns you are going to backtest on your charts first, and I will see you in our next session.